மார்க்கெட்டோட நிலவரம் மேல போகும் கீழே வரும். இந்த ட்ரெண்ட் எல்லாம் பார்த்து ஆசைப்படாதீங்க. கொஞ்சம் கொஞ்சமா நீங்க பண்ணுங்க இன்வெஸ்ட். கனவு எல்லாம் நினைவாக்குங்க, இதுதான் பெஸ்ட். ஸ்மார்ட் மற்றும் சிம்பிள் பிலாசபி. ஸ்மார்ட் மக்களுக்கு இதுதான் ஐடென்டிட்டி. டெஸ்ட் பண்ணு நீ, ஸ்டார்ட் பண்ணு நீ. சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான்ஸ் அண்ணா சொல்றத கேளுங்க. அண்ணா ஸ்மார்ட் ஆகுங்க. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. பண்ணனுமா 350cc சவாரி, இல்ல செகண்ட் ஹனிமூன்ல ஆப்பிரிக்கன் சஃபாரி. கட்டணுமா ட்ரீம் ஹோம் இன் டவுன் பேமெண்ட், இல்ல செக்யூர் பண்ணணுமா ராக்கிங் ரிட்டையர்மெண்ட். பிளான் பண்ணணுமா உங்க ஃபாரின் ட்ரிப். நான் செய்ய வேண்டியது ஸ்டார்ட் தி சிப். ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயங்களுக்கு உட்பட்டவை. முதலீடு செய்யும் முன்பு திட்டம் சார்ந்த ஆவணங்களை கவனமாக படிக்கவும்.
मार्केट्स की लकीर, कभी ऊपर कभी नीचे, कभी होना ना फिदा इन ट्रेंड्स के पीछे। छोटी छोटी किस्तों में करो तुम इन्वेस्ट और बड़े बड़े सपने जियो, क्योंकि ये है बेस्ट। स्मार्ट और सिंपल फिलॉसफी, स्मार्ट लोगों की यही है आइडेंटिटी। टेस्ट कर ले तू, स्टार्ट कर ले तू सिस्टमैटिक इन्वेस्टमेंट प्लान्स। भाई सुन मेरी बात, भाई बन जरा स्मार्ट, चल कुछ स्मार्ट कर, SIP स्टार्ट कर, चल कुछ स्मार्ट कर, SIP स्टार्ट कर। करनी हो 350cc की सवारी या सेकंड हनीमून पे अफ्रीकन सफारी, भरना हो ड्रीम होम का डाउन पेमेंट, ये सिक्योर करना हो एक रॉकिंग रिटायरमेंट, प्लान करना हो अपना फॉरेन ट्रिप। ऑल आई नीड इज टू स्टार्ट अ सिप। चल कुछ स्मार्ट कर, SIP स्टार्ट कर, चल कुछ स्मार्ट कर, SIP स्टार्ट कर, चल कुछ स्मार्ट कर, SIP स्टार्ट कर, चल कुछ स्मार्ट कर, SIP स्टार्ट कर।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
I can't hear.
Loki, you're on mute.
Done. Can you hear me?
I can hear you now. I can hear you well.
Yeah. Shall I start? Yeah. Hello and welcome to Smart Investor, an investor education program conducted by ICICI Prudential Mutual Fund along with the Hindu BusinessLine. The topic for today's webinar is how to get started with mutual funds. I take great pleasure in welcoming Mr. Dhirendra Kumar to this webinar. He's among the most well-known and credible voices in the Indian mutual fund industry today. Mr. Kumar is the founder and CEO of Value Research that has been providing information and research on mutual funds since 1990. He brings with him a wealth of information gleaned from 3 decades of observing and analyzing the mutual fund industry. Thank you so much for joining us, Mr. Kumar.
Thank you. Thank you, Lokesh.
We'll have a conversation with Mr. Kumar in the first part of the webinar, after which we'll be taking a viewer's question. So please do type in your questions in the chat box below, and we'll try to take as many of them as possible in the second part. So when we talk about starting to invest in mutual funds, most of us would be thinking about people in their 20s, maybe who are just about beginning their careers. But that may not be the only segment that is actually left out, because there are those in their mid-career or even close to retirement or post-retirement also, who may be thinking, is this the time for me to take the plunge in mutual funds? In India, the assets of the MF industry is around 28 lakh crore. But bank deposits have assets of about 138 lakh crore, which is over 5 times in size. According to RBI, the average Indian household holds 84% of its wealth in real estate and other physical goods. 11% is invested in gold, and only 5% in financial assets. And of these financial assets, about 56% is in bank deposits. So the numbers do show us that many of us do save, but are we investing? So that is a question here. So due to paucity of time and maybe inclination, even we may be setting aside money as saving, but we may not be really doing so with the expectation of making this money grow. So this tends to make an enormous difference to the wealth that is ultimately accumulated. So with that, let me turn to our guest, Mr. Kumar. Before we move on to how to invest in mutual funds, I want to set right the why of it. So do you think that MF should be an integral part of every portfolio? And what, according to you, are the compelling reasons why mutual fund investment is essential for wealth creation?
Uh, yeah, I think, mutual funds should be the primary way in which people should be investing. India has been a fixed income country, and there are historic reasons behind that. The reach of the market, the reach of the mutual fund wasn't there. Now it is. And also this digital access, or it has been made access, democratization of mutual fund is possible today across the country, because all you need is a smartphone and an Aadhaar card to get started, and an online bank account, and the Jan Dhan account which people have. So that makes you eligible to start your mutual fund investment. Earlier, it was not possible. 10, 15 years back, it was not possible. And the cost of reaching out to a large number of people, it wasn't there. Mutual funds do. And what is the compelling reason? I think, it's very straightforward, not looking at anything complex, but simply convenience and diversification. You reduce your risk by diversifying, and the convenience of getting started, ability to buy into a diversified portfolio with a 500 rupee monthly saving. I don't think you can get it anywhere else. That reduces your risk substantially, and it's very important for investors getting started, because if you try your hand try your hand by investing in any market linked investment, and it could be very disappointing, and it could be disappointing is one part. The other part is that it will be disappointment, and it will drive you out of the market, and you will be deprived of investing in market linked investment, which is the only hope, because all the statistics which you just said at the outset, that India, of all the financial assets, 53% or 56% was fixed deposit. The interest rates are coming down. People are in for disappointment. Retirees will put their money, they will find that they don't have enough. When interest rates come down from 9% to 6%, it might look like 3 percentage points. It is actually a third of your income which is gone. So that's quite meaningful. So people will have to work towards optimizing their return, and this is a vehicle which can help you optimize, and with great simplicity and convenience.
Okay, thank you. So having established that investors need to look at mutual funds, so let's now move on to what is the category of mutual funds that they need to be looking at? Because there are numerous categories of mutual funds, like equities, debt, hybrid, solution oriented. There are subcategories also. And if a guy is just beginning and is just thinking about putting a money in mutual fund, he'll be really bewildered and really wouldn't know what to do. So, and also not all categories of mutual fund are suitable for everyone. I think you'll agree about that. Let's break down the new investors into 3 categories according to age. I'll just bucket them, and then I'll ask you one by one. So you can tell me which category of fund would be most suitable to that particular bucket. Mm-hmm. Okay, so let's begin with the younger ones. Suppose those in the 20s, they're just about beginning their career. They just started earning some money. So if they think that, okay, I have some savings, so let me start putting some money in mutual funds. So what should they be looking at?
I would like to keep it very simple. Mutual fund, undoubtedly what was supposed to make your life easy, simply because of choice, it has become very complex. Officially there are 32 kind of open-end mutual funds possible, and all kind of variations within that. So there is a problem of plenty, but you don't necessarily have to. It's have to look at all the categories and get into a detailed study of anything. I think from an investor's point of view, for somebody who is starting now, for a young investor, if he's going to be a taxpayer, if he's in an income bracket where he's likely to pay tax, I think the first option should be availing your 80C through the tax saving fund. Why so? Because mutual funds, it's important that you invest your long-term money. And investor's mind actually, is very malleable. Many investors say that I'm a long-term investor, I can take the risk. But when they're faced with a 10% decline, they say that, no, this wasn't the deal, or they're very disappointed. So it's important and you don't benefit from the ups and downs of the market till you stay for a full market cycle. And I think 3-year lock-in period of tax saving fund plays a very significant role here. You'll be disappointed, but in most cases, 3 years, you'll end up making more money than all the alternative fixed income avenues that you have, which is in a public provident fund and other alternatives. So I would say that start with a tax saving fund if you're a taxpayer, or start with an aggressive hybrid fund. Aggressive hybrid fund because anybody who's starting, one needs a steadier take on growth. Most investors will be fine with a rapidly growing market or a rising market, but they're not prepared. And it is very important to put your toes in this jungle carefully. So it has the shock absorbers built in. A third of your money or maybe a quarter of your money will be in fixed income. When the market collapses sometime in between, you will not be driven out of the market. You will not get as scared. Of course, that can also be disappointing, but not as much as a pure equity fund, which ideally somebody in his 20s should be doing. But I think for the first 2-3 years to acclimatize yourself with a market-linked investment, I think it's important to start with an aggressive hybrid fund or a tax saving fund if you're a taxpayer.
Okay, so let's move to the next bucket. Suppose it's a 30 to 50 years bucket. So those who are actually working and in their mid-career, they have not really invested in mutual funds so far. Maybe they have their money parked in the banks or maybe property and so on. So what's the category that they should be looking at?
For these people, also if they're going to invest for the first time, aggressive hybrid fund is the alternative. In fact, more importantly, because these people, they are used to the fixed income return. And everybody says that, okay, good return is fine, but the lack of predictability and sometimes bad years. When we look at long-term returns from mutual fund, we find the numbers very handsome. But what it does not reveal is that in between, if you look at 10-year return, 5-year return, many funds, many categories, the returns will be very impressive. But it will come in fits and bouts, which is very difficult to absorb. It'll have, the hidden thing will be minus 30%, minus 20%, some years 100% gains. And if you look at most recent 3 years, the numbers look like this. So it's very important to actually start in a manner that you develop a belief. And I think aggressive equity hybrid fund is the way to go, even for this age bracket, because a dramatic decline in the market, and these people once driven out, you stay out forever.
So you're saying they start with the aggressive hybrid, and then after 2 or 3 years, they can move on to other categories. Is that
Absolutely.
what you're saying?
For 2-3 years, this acclimatization of a marketing investment is crucial, because if you don't get used to it, and the other thing is that you have to reduce your risk of eliminating the risk of catching a market high. So one should make sure that you're not investing a large sum of money at one go. Even if you have large sum of money you have accumulated in your bank account, or if your fixed deposit is maturing, or if you have sold an asset, or if you have got superannuation benefits, still we should spread your money. And depending on the scale of money, you should actually choose the time frame. It could well go up to 3 years, and at least even a meaningful sum of money. If you get your annual bonus and you need to invest, maybe spread that investment over the next 6 months. But averaging your investment is very important, because the regret of catching a market high is very deep. It scares you, and that regret drives you to managing our behavior is crucial when investing in any market-linked investment. And these are simple ideas, simple mechanism, possible and enabled by mutual funds to do it.
Okay, so the last bucket is those above 50. So they could be nearing retirement, or they could be even those who have the retirement funds in their hands. They might be thinking what to do with all these funds that I have got. So what would you suggest for this category?
For this category, they need to really turn more conservative. And depending on, broadly, if I have to, I can segment this audience over 50 into three categories. One, the people who will be depending on their investment for income. Then there will be another segment which will not depend on regular income from their investment, because they will have some pension or some rental income or some such thing to support. And third will be, it is just it's a long-term money. They don't depend on it at all. And if these people, any person in this segment, if they haven't invested in mutual fund, I think the right way to start is equity savings fund. These are actually the opposite. The allocation is opposite of the aggressive hybrid fund I was referring to. Equity savings fund, a quarter of your money is invested in equity and 3/4 is invested in fixed income. So you are unlikely to see a dramatic fall. And here too, it is important because of this equity component and because it's a conservative take on growth. I'm hopeful that this is a category which will help people beat inflation by a modest margin, and spreading your investment at least over some time frame, and depending on the scale once again. If it is your retirement corpus, maybe spread it over the next 3 years. If it is any other, something, it's very difficult to formulate a rule. But I would say that broadly speaking, if I have to formulate a rule, I think one should follow that as much time it has taken to earn you half of that, but not exceeding 3 years.
Okay. So having discussed the category of funds that people should be looking at, I think the next step is the fund selection itself. So suppose there is an investor who is savvy enough and he thinks that he can go and do the fund selection himself, and he can do all the number crunching and so on. So what according to you are few of the metrics that a new investor should be looking at? Because most of them start with looking at the NAV returns of the last 1 year, which is not the ideal metric. So
chasing recent past performances, investors, biggest folly, and it's fashionable and it is very tempting. Everybody thinks that you can also have a similar ride just because it has happened in recent past. And normally, the reality is that it's over by the time you are attracted to any compelling return in recent past. So, and it turns out to be the biggest disappointment. So it's very important, first and foremost, one should be very careful with the kind of fund that you're choosing, the category in which you have to see where you should be investing. So as I was saying, for a first-time investor, that be in a, choose a conservative vehicle or choose an aggressive vehicle, but even the aggressive vehicle has, far greater stability. So one is choosing the category. And here I would say that, I follow, if I have to choose a fund, I will follow 3-4 steps. One is our rating system, or maybe Hindu BusinessLine has a great rating system. And I think having a narrower universe of 5-star and 4-star funds. So that I find that, eliminating and narrowing your universe. So first is choosing the category, narrowing the universe. And after that, consistency of that return. And the final check is the fellow still around? Is the fund manager still there? Because you have all these returns generated. And if he's not around, then, he's the most important person. So that is something which you'll have to check. And so consistency of return and the risk-adjusted numbers which are driving the star ratings. I think that is. I would not say that choose. That should be the ultimate driver. It's a good filter to have, narrowing the universe, because we once again, even in a category, we have a problem of plenty. So I think this 4-5 steps should actually enable you to do it with great confidence.
Is it also important to keep in mind the pedigree of the fund house when you start picking a fund?
Yes and no, because in a way that most mutual funds are so tightly regulated and they're so intensely regulated that if somebody actually crosses the line, I can't think of very objective parameters. Yes, there are smaller companies which can get out of business, but I have not seen, I find the regulation to be very impressive, unlike many other sectors where because of any mishap in the company, investors have suffered substantially in a permanent way. So I would say pedigree is important. Somebody has to work a little harder to protect their reputation. But I think mutual funds, we haven't seen it should be one of the criteria, nothing beyond that.
Okay. Okay, so once the fund is also selected, so the next step would be the process of investing itself. So we have, of course, two options. He can either take the direct route, or he can use the services of an advisor or distributor and so on. So can you give the pros and cons of these two routes?
Yes, pros and cons. Direct is cheaper, and so if you you have to be on your own. Nobody is there to help you. Nobody is there with any of these qualitative things which I'm referring to, which fund to invest in, how to invest, and all that. And you will have to do everything yourself. And it has become easier. It has become relatively easy. It is not very difficult to be investing in the direct plan of any fund. You can go to the fund house's website, they are enabling it. You can go to some aggregators, and there also, there are apps which are enabling investment in direct plans. The advantage of a regular, in case of regular plan, you have a handy, friendly neighborhood person who is guiding you through the whole thing. That is quite confidence inspiring for many people getting started. It is 1%, 0.75 to 1% more expensive in some cases, in cases of equity fund. But that could be very confidence inspiring. The problem is that over a long period of time, this small difference in return can compound to something substantial. But I think it is better to be going through investing in a regular plan through a distributor, through an advisor, and making sure that you start, because the biggest problem investors face is not about the selection and all this. It is procrastination. We avoid, we have so much of spending avenues that despite having savings, we don't invest. So, at least here will be a fellow who will have the incentive to drive you to invest and not let your money remain idle. And I think that is also a very important role.
Okay. Point taken. Another decision that an investor would have to make is whether he should take the systematic investment plan, the SIP route that's become so famous over the last 4 or 5 years. Because now I think a SIP, the word has become more famous than the mutual fund itself. People know SIPs more. So should they be doing a SIP or a lump sum? I think in the earlier questions, you did say that you should spread out your investment if you're a new investor. So what is your views on the SIP? Is that the right way to go for a new investor?
No, Lokeshwari, it is not only the right way, it is the only way for somebody getting started. In fact, if somebody is telling you that invest this large sum of money tomorrow, I think that is pointing to the fact that he doesn't understand it. He lacks the experience. So investing through SIP, your long-term money into market-linked investment, is not a matter of choice. It's the only way. And spreading that investment over what time frame is the only question. And I don't think it is easy to call the market, take a call on the market appropriately. I haven't come across any fund manager who has done it right. Not too many people have been able to anticipate any big decline or a big surge. So you have to remain in the market. But to manage your own mind, to manage your own emotions, you have to spread that investment. So it is not a matter of choice. It's the only way.
Okay. So what you must have done a lot of number crunching on this, that investing through the SIPs and taking a lump sum. So what do the numbers actually show? Is it or is it just not about returns and it's about discipline? That's what you're talking about.
Yes, it is not about returns, it is about discipline. And even, the returns are actually, there are plus and minuses. There are situations where you'll be deprived of some opportunity. If you invest in a market which, if somebody would have had lump sum money at the beginning of 2002, and he decided to spread his money over the next 3 years, he would have been a loser, because you could have bought low and sold high if you invested all that money at one go. But think of a person, who started it, who would have invested that lump sum money at the beginning of, or sometime in the middle of 2007. He would have seen a big decline, a 50% decline in his accumulation in the beginning of 2008, and in a couple of days. And that is quite unnerving. That is quite unnerving because, you have to understand that market-linked investment and equity, more so equity, the up cycle is like going on the staircase, and coming down is like taking an elevator, and that is very scary. Even experienced investor who have been investing for a couple of years, who are not used to it, it prompts them to get out of the market at the very inopportune time, and they are deprived of this great avenue of turning your small savings into a meaningful capital over a period of time.
Mm-hmm. So you're saying the period is left to each investor, but what would you say is the ideal time for a SIP to run if you're a new investor, we say 1 year or 2 years?
No, I would say that, it just fits with your income cycle. We get our salaries every month. We pay
Okay.
monthly,
you mean.
Yeah. So I would say that, don't complicate this, and do it for 1 year and revise it, because a lot of people, everybody's mental calculation of SIP or the kind of illustrations that you see is in constants, that you do 500 rupee or 5,000 rupee or 10,000 rupee. Make it a percentage of your income. And our situations changes, early stages of our career or, our work framework, we hardly have savings. So that is more a matter of, getting into the habit of investing your savings. So even small amount will do. But as you progress, there will come a situation when your children are grown up, their education is taken care of, you don't have a loan to repay. And that is the stage where you have money when you actually don't need as much. So making it a meaningful part of your income and revising it periodically, because we do all these calculations based on a constant sum of 5,000, 10,000, depending on, and they look neat and simple. But the reality is that, if you start with a defined income, revise it up and update it annually, that is how it should be done.
Okay. So suppose he has already invested all the funds, and also you did say we should. So what is the frequency with which the portfolio, whatever he has bought, the performance itself, that should be reviewed. And there should be some events that actually trigger a churn, switching from one fund to another. So can you talk about these two things, or the frequency with which you should be reviewing the portfolio itself, and when should you take the call of churning the funds?
Yeah, I think, it's more important to actually how not to monitor than actually how to monitor. So I think, monitoring is pretty simple. Don't do it every day. That will actually cause a great deal of anxiety. When you see these big ups and downs every day, you will be thinking that you're smart, and someday you will be thinking that you're stupid, simply because the market has moved so dramatically. And none of it is true. The fact is that, our investment in equity or equity-linked investment is a general bet on economy. We will be better off in a few years from now. That's the general thinking. Businesses that we are investing in, we are diversifying. And you're doing it with convenience. That is all there to it. I think how not to monitor, don't look at these values every day. Don't look at short-term performance of your portfolio. But I would say that, spend 15 minutes every 3 months to look at how your investments are doing. Monitor it very closely, upload your, you can do it at Value Search Online and many other places where you will get a precise asset allocation. I think your asset allocation is a very crucial thing. How much of your money is in equity? How much of your money is in fixed income? Because normally what happens is investors end up being collector of, funds. They are not investors. Something comes your way and you invest 5,000, 10,000, 15,000, and you end up with a big bundle of, varied kind. And then you are not, there are 2-3 disadvantages of this. One is that you are not able to monitor it closely. You are less interested. If you have meaningful sum of money invested in few funds, you will be interested that it makes a difference to your life and you will act. You should churn. And as I said that, all the reasons, all the factors which I was referring to, which should go into the selection of the fund, the converse of that should actually lead to selling of that fund, which is a steep, big decline in rating. So that should be a prompt to look further. trying to understand, under the hood, under the bonnet, that what is driving this lack of performance, or why the reason why you bought the fund, has it changed? Because many a times investors will be looking at absolute return, but if all the funds of that category are struggling, or the market is not in a great form, it may not be as disappointing as one might be thinking. So I would say that think in terms of take a closer look every 3 months, and and if your asset allocation has changed, that is something which I think most investors are not geared to do it with so easily. So use one of the online tools, or that you should be demanding this from your distributor or your mutual fund agent or advisor, that big shift in your asset allocation. If you have chosen to invest 50% of your money in equity and 50% in debt, and your 50% equity has become 60%, as a result of which debt is now 40%, move 10%, rebalance it. Your quarterly review should translate into, but don't do it very often. It will have tax implication. It will complicate things. If it is within a 10% range, don't do anything. But if it is a dramatic shift, do that. And so you are not taking a very knee-jerk view of things. You are just moving a part of the money. And so individual funds, you should be looking at the converse of the variables which goes into selection, and asset allocation, which should drive your change from equity to debt, or debt to equity, depending on your own personal asset allocation. And be very firm with this. Don't get indisciplined about this. This will actually deprive you of many of the long-term growth as well. It is just like SIP. Sometimes it benefits, sometimes it hurts. But I think it's very important for you to not have regret, and not have big regret in terms of being out of the market, or not selling when the market was at its peak, some part of it. So that will work as some great shock absorber, and help you remain there for 20, 30, 40 years.
Okay. Some of the funds, like you said about the hybrid funds, they have this asset allocation built into them.
Yeah.
But if someone wants to create a portfolio of equity and debt itself, so how would you tell them to go about their asset allocation? How would they judge that?
The online tools are available now. Value Research Online actually aggregates your stocks, NPS, PPF, and I would say not only fixed income, because as an individual, most people's biggest investment turns out to be public provident fund or employee provident fund. Our biggest reduction, and that is fixed income. So it captures all that, and you are able to get a complete picture. You actually get a sense of what you really have. Because we tend to think of mutual fund as a segment. No, the underlying is all equity or debt, and if it is getting aggregated, you will get a character of it as well. So look at it there, review it every 3 months, and these online tools are very easy to use now, because and particularly mutual fund, putting your PAN number and your email ID is mandatory. And if you do that, I don't know if PAN number, if email ID is mandatory or not, but I think every fund actually captures that in your application form. As a result of which, you get a consolidated account statement. A consolidated account statement is spread across all fund companies. So requesting one consolidated account statement from your from Carvi or CAMS, the two biggest registrars, and uploading it at one of these services actually enables you to get a full understanding of this, your asset allocation precisely, and also can be a great prompter to what to do.
Mm-hmm. It also depends on the risk appetite of each individual, isn't it? The asset allocation part.
Yes, yes, absolutely. As I was telling you, in the initial part, I was telling you that equity savings fund for somebody who is older and investing, so that is embedded there. Only a quarter or a third of your money is invested in equity. Likewise, for somebody who has time, even in their 20s or 30s and 40s, it's 3/4 in equity. Only a fourth of it is in fixed income. So undoubtedly, but I think don't complicate this beyond a point, because don't be very precise about it. Keep a margin or keep a window of 10% variation, and because I fear that most investors, if they go about making changes on 1% or 2% change every now and then, it will just complicate things, create a lot of tax incidents, and make paperwork very complicated. Do it less often and do it only on big shifts. And I would say that if you have to really define on the asset allocation, somebody who is in his 20s can well have 100% equity, because you need asset allocation only when you have accumulated something, which if it declines and you have regret. But in the initially you don't have that, you don't have any regret. You are starting your first 10,000 rupee, and next 1 year you will have 1,20,000 rupee invested. So you don't have much to lose. So I think, if a young person in his 20s can and that is what is happening with the tax saving fund. It is an all equity option, or is the only all equity tax saving option. So that's one way of looking at it. So 100% equity, 1/3 of it in equity, 2/3 of it in equity, and half in equity. So when I retire, I think I'll have 50% in equity, 50% in debt. Simply because I'll have the experience and realign my portfolio, rebalance it every 3-4 months, and that should take care of it. It is very important to understand that your fixed income, you should be looking at looking at the full picture, which is your PPF, your Employee Provident Fund, your FD, because there'll be different things with different liquidity, and all of it, and some of them will have merit. It will be justified to actually have it. I think having a full picture of your financial affairs in all your financial investments together is important.
Okay. So goals is something that it's very important in financial planning, I suppose. Yeah. So how would the fund selection differ based on the goals for which it's being accumulated? We talked about the retirement, of course, but if someone is saving for the children's education or their own marriage or something with a young person, so what would you suggest?
Yes, in fact, when I'm doing, if I have to actually choose a fund for any person, there are only 2 factors which actually help, maybe 3 factors. One is what is the time frame, and that will help me choose the category, because if you are investing for many, many years, definitely go for equity. If you are investing for a couple of months, you should not be investing in any kind of fixed income fund. Very few kind of fixed income fund are appropriate for you. Likewise, for a long, and so the first factor is your investment time frame for that goal. That is the first determinant. Second one is your experience with the market. If somebody will be comfortable with a 30%, if somebody did not sell his investment in the month of March, he's a different person as compared to a person who started his SIP a year ago and he was running for cover in the month of March. You need to really work on this differently. One should have been investing in equity savings fund, it would not have caused that much of heartburn. So I would say that experience, your investment time, the time to your goal, this is the crucial factor which should help you, not be disappointed with your investment.
That's a very important point, because I think instead of looking at the events itself, just look at the time frame. I think that's
yes. I was referring to the third point. Third point is how crucial is that money? I'll just cite you with that as an example. Somebody might be comfortable with losing 10 lakh rupees in few months' time, and there is a person who will be actually very upset, and his goals will be completely, he will be deprived of something very significant. If his investment values decline by, a lakh of rupees, your child education can get disrupted, because in financial investments are, they affect real life situations. It's not a game. So in that sense, how crucial is that money? And if that money is very crucial, then, take a more conservative stand. Even if that, for example, if somebody is investing for his child's education, and which is 5 years away, but somebody has a margin of, error or margin of safety and has, large accumulation. So he'll be more comfortable absorbing an interim decline. But that person who is saving, who will barely have just enough, he'll be very upset. So he needs to approach that a little. So how crucial is that money? And it also influences your behavior, because you're, somebody who has accumulated something for his child's education over the last 20 years and it is barely going to be enough, his behavior will change dramatically as compared to a person who will have margin of this error, a big decline, and he can still ride over it or tide over it well. So how critical is that money, the time frame to investment, and one's experience? I think these are crucial inputs to choosing a fund.
Okay. There are these tools like SWPs and STPs and all that. Do you think the new investors, they should be aware of these and start using them? I think retirees may be using them. What are your views on that?
Oh yes, in fact, these are, they look very simple. But I think they are quite magical things, because this is SIP, SWP, and STP is a machine, is a mechanism of converting your small cash flow into a meaningful capital, or turning, a meaningful capital which generates, regular income for you. So it's quite self-explanatory. SIP, I was just listening to the audio visual in Tamil, which I don't understand the language, but I could still understand that it was full of enthusiasm that, for your goals, invest in SIP. So I would say that do that. Turn your small contribution investment into a meaningful capital. This is the only way out, as I was saying earlier. STP is the converse of that. You have large accumulation and then you start withdrawing from it, and you are going to depend on that income. I would say that, all the money that you have invested, and if you're lucky to be investing in equity over the last 20, 30 years or next 20, 30 years, you will get a positive surprise. I'm not very sure about the next 5 year or 7 year or 10 year, but next 30 years, I'm very confident that, one will be, and that is what I see, that over longer time frame, equity turns out to be best asset class. And if you have something meaningful, some meaningful capital which is accumulated, turning that into a meaningful cash flow for you till you, and so that you don't outlive that saving. SWP helps you to do that, systematic withdrawal plan. And STP is, as I was saying, that even if you are, if you're lucky to get if you're saddled with a large sum of money, which has to be invested, and you must average that investment. You can never invest your large sum of money at one go. The kind of anxiety it causes. So for those people, invest in a relatively more stable, investment, a fixed income fund, and it's like a standing instruction of, putting your money in a fixed income fund and investing in equity over a period of time. It simplifies your transaction. If you have 10 lakh rupees, which you invest in a fixed income fund, and you give an instruction that move that, 70,000 rupees every month till that money is exhausted. So you are able to average your investment and save yourself from regret. Sometimes some opportunity as well, but that is well worth it.
Okay. There's also this active and passive debate that keeps going on. Should new investors be looking at passive funds also, index funds or ETFs and all that?
Yes, recently, at least some index funds have, particularly last year, this debate is on. And I don't think we have a conclusive answer. The jury is still out. But I would say that, large cap funds, which used to be the main, staple of an investor's portfolio, passive funds have built a very strong case. And their case is built on very simple premise, which I think is quite sustainable. The cost of, the management expenses, the cost of a passive fund, or of an active fund, is going to be, 1.25%, as compared to 0.25% of a passive fund, of the index fund. And this 1% differential is very meaningful, because an active fund manager has to beat the index by 1% to match the index. And then comes, his return, then comes his alpha. So how he will go about doing it is a matter of, so I think large cap funds, yes, one should be looking at these, index funds. But other alternatives, I don't think investors have those options. In India, I think there are only 2 index funds which is available, which is meaningful. One is the NASDAQ 100, if you have to invest in the US market, and particularly technology companies, and Sensex and Nifty options, which is somewhat similar. The overlap of the portfolio of Sensex and Nifty is quite significant. We don't have those popular mid-cap index, or they haven't achieved the threshold scale. And it's a chicken and egg story. I think the index fund has to get bigger to become meaningful, and then they attract more money. So I don't know when they do it. But and Sensex and Nifty funds have achieved that threshold scale simply because Employee Provident Fund and NPS started investing in them. So that is Employee Provident Fund as well. So that is a very sizable money, and the expense ratio of those funds are very small. So that gives them a significant advantage over active funds.
Okay. So it's time now to move on to audience questions. So before that, we'll run some mutual fund disclaimers, a few slides that SEBI wants us to do.
This should be okay. Doesn't matter. Do it quickly, whatever you do. See one of the lights up. Let's do these ones. Is brighter better? Okay. Switch on those lights. Hang on.
Okay, we are back. So we have a lot of very interesting questions. There's one Mr. Dinesh Kumar who's saying that he's a graduate and yet to get his first salary.
Okay.
So he's asking you to tell him what percentage of the salary should he invest in mutual fund?
Oh, that is not for me to answer. I would say that, even if you skip investing from your first income, it's all right. If you have to really buy that sari for your mom or, all those things that we have in store for ourselves, it's fine to be spending. Make sure that, it's good that you're asking this question, and it definitely shows your interest and your inclination. Start from the second month. And, I would look at it, and I'm nobody to actually give you, no expert can provide you any guidance on that. It's all dependent on your, if you have an educational loan to pay, it will be different. A loan to repay, it will be different. If you have if you're unable to save, all your income will be consumed. Maybe, I think, but you should save, you should invest a small amount, even if it be 250 rupee or 500 rupee. I'll tell you why. The magic of compounding. A lot of people underestimate the value, and any kind of attending a seminar or a webinar or any such thing, or getting illustration in a fine illustration anywhere will not help you appreciate that. When you put your 500 rupee, and if you're unable to do it in mutual fund, do it in a recurring deposit. Just see that how you actually are able to accumulate a small amount of money and do it. And investing through SIP in any mutual fund is very easy today. If you do it with 500 rupee and you see that in 3 years time you have 18,000 rupee gone in, has been invested, and what is the worth of that capital? First is the joy of having 18,000 rupee value itself is very significant. And then you become a believer. So I would say that it is more a matter of, getting into warming yourself for a lifetime of savings and investment in your initial few years. So do it from the next month if you have any such plan. As I was, telling you to spend all the money, but do this.
But isn't there any thumb rule that about 20-30% of your money should be set aside when you're younger?
No, Lokeshwari.
You don't believe in all that?
No, there is no thumb rule actually, because everybody's circumstances could be different, and in fact, there is actually no thumb rule for even for age-dependent investment. There are there are generalities in so to say. But if I'm a young person and I have to still worry about, I have a joint family and I have to worry about my, I have to take care of my family or parents. Maybe I'm a 20-year-old and I will be, I'll be stressed. I won't have savings. So it entirely depends on where you stand and what your circumstances are. There could be, I've come across 70-year-old people with large accumulation and they have nothing to do with that money. They are long-term investors from there on. So you can have a retired person and you can have a young person who will not have enough money for his own wedding, and he's accumulating that money, and that could be a short-term investment, that could be a medium-term investment. So look at your goals, try and estimate, and there are negotiable goals and there are non-negotiable goals. Negotiable goals, by that I mean, buying a house, you can buy it in sometime between 3 and 5 years, but your child's education can't wait. It happens on a specific date and you must be prepared for that. So having your emergency fund. So you must have that, having that foundation well in place so that your, otherwise a long-term investment plan does not get derailed is very important. So doing all, taking 4 or 5 steps for your long-term journey is very important.
Mr. Raghunathan MS, I think is an NRI. So he wants to know for NRIs, what are the avenues? Is it same as domestic investors? In mutual fund status.
Yes, for NRIs it's the same, except that some jurisdiction they have to report their all the earnings have to be reported there, and particularly US and Canada, and the FATCA compliance. So Indian fund companies report in a collective way, share that information. So having you will have to comply with those rules, and the Indian domestic rules are the same.
Okay. Mr. Shridi, he's saying he's putting some money in direct equities and in equity mutual funds. So is this the right approach? I think during the pandemic, a lot of people have started putting money directly in direct equity also. So what is your view on this?
My view is that, you invest your long-term money into equity. You invest directly into equity or invest in an equity fund is a matter of, if you have time, if you have inclination, and if you're not speculating, if you are doing it with an understanding, by all means buy equity. But if you are doing it randomly, if you are just taking tips and and pretending that you are making some investment, without an understanding, it could be a very dangerous thing. If you have a plan of investing in equity, you have the time and you have the inclination and you have interest. You like to read balance sheet. You want to understand that this company makes, because I come across a lot of such investors who don't know what that company does. But he will have, think of yourself like being an owner. You are becoming a part owner of that company the moment you buy the share of that company. If you don't have that mindset, entrust your money to a mutual fund. If you have that mindset, yes, it could be a very interesting thing to do. It could be intellectually stimulating. And for all such investors who want to really leap there, I would say that if you have built all your accumulation through mutual fund, do it gradually. Why not do it, first year, try it with 10% of your money and compare the fund performance and the equity performance, then take it to 25%, then take it to 50%. So you will have the proof that, because you are basically trying to compare yourself against a fund manager and where your money is invested. And if you find that you are very impressive as compared to a fund manager, then maybe avoid mutual fund. But I think the jury will be out only after you have done this. Based on last 3 months, 6 months, 8 months, and you really have to see that how you do well in a full market cycle. So as I was saying that, if you don't have those 2-3 things, if you're not a long-term, if you don't have that long-term orientation, if you don't think like an owner, if you don't enjoy, but you simply get a tip and invest, that is a very dangerous and risky way of investing.
I think the same person is, one more question is asking is, one of his friends suggested to him that they can buy the same stocks from the market which are in the MF portfolio instead of going through an AMC. so they can save on the AMC fees. So what would you say for them?
No, but it's a matter of the aim. The fund manager will actually go about making changes in his
Exactly.
portfolio. He will have different mindset. And a fund manager has some advantages and disadvantages. A fund manager has the advantage that he's managing a large pool of money. His orientation, he will have some of his compulsions driving him to invest in a certain part in large caps, so that all his redemption requests are honored, or he would like to ensure liquidity. Individual investor with greater understanding can actually compromise on that. The liquidity for you, if you are able to sell 10 lakh rupees worth of a stock, it is good enough liquidity for you. But if a stock sells only worth 10 lakh rupees in a day, that is very poor liquidity for a fund manager, and the fund manager will not even look at it. I would say that that's not a great way of doing it, and replicating. And what he will be doing during the month, because the portfolio disclosure is monthly, you also many a times don't get the full portfolio disclosure. So what he's doing during the month, you will not have access to. Third is that sometimes you come across situations where fund managers are taking cash call, and when they are right, it's quite rewarding.
Mr. Radhakrishnan EC is raising a question that the performance of MF schemes in the last 1 to 5 years has not been so great, and he's concerned about it. So he's saying, can you please tell what should investors do?
I would say that have patience. Yes, last 2-3 years it has not been good, and more so, fixed income funds have been very disappointing, simply because the ups and downs, and also the Franklin episode that happened has been very unnerving. But I think that I would look at it as a very one-off event. It was actually a calamity, and it was an accident happening in the middle of a storm. I don't think one can take a lesson and do something about it. I think I take it as a one-off thing, which should get resolved over in some time. Relatively poor performance, I think that will be taken care of in a full market cycle. What we see today, many funds are unable to, have not been impressive, because the whole market has not been broad-based. The market rise has been dependent on a very narrow set of the large cap universe. So we find that large cap funds have done well. Index has beating the index over the last 1.5 years has been very difficult. Some of the funds have also unless there is a broad surge in the market, which I am hopeful that we will get in a full market cycle. And those numbers have to speak for themselves. Right now, I think 1.5 year return, 2-year return is not good enough for you to take a call on this.
Mr. Abhimanyu Hingorani, he's saying that always there have been certain themes that have done well in various market cycles. For instance, now of late, gold and pharma have done well. So he wants to ask you, what are the themes which you think will emerge in the post-COVID era, so that he can do his fund selection based on that?
I'll tell you, in the past, I've tried to do this, tried to guess which theme will work, and I've been it is embarrassing to be guessing this. So, and I have always been wrong. So don't go by my opinion, but I'll tell you, gold or pharma, if it has done well, there is a reversion to mean. Sectors and sectors or segment of the market which are not doing well, they tend to do well as things change, and there is a cyclicality in the market's preference for them. So simply, I am just beginning to see the PSU stocks doing well after a very long period of disappointing returns. So simply because it becomes under-owned, and it suddenly looks very compelling or very attractive. Because it is ignored for a long period of time, and for other reasons too, like the pharma story. 4 years ago, the story actually got killed, in the sense that 10-year return of pharma funds 4 years ago was looking better than all categories. So such long-term outperformance. And then we came across this context of FDA investigation against all Indian pharma or leading pharma companies. And they all went out of favor, and understandably, it was a very hugely disruptive thing. And the industry has made a comeback. Industry has made a comeback with a lot of correction, a lot of fixing their own businesses. complying and making sure that, and they have the approvals, and I think they have, a lot of them have changed the way they function today. So I would say that this is reversion to mean. Something which is out of favor will, if it is not going to die, then I think they'll do well. So from that standpoint, PSU as one segment, or banking, which has been completely out of favor for understandable reason. We have seen the whole surge, a significant part of the index as well. Despite that, we have seen a good number of banks. Only two, three banks have done very well over the last 2-3 years in the stock market on the price performance. Otherwise, everything has been out of favor. So I think we will have select situations there which will do well.
When Mr. Ashish Singh is asking, does third-party tools good for mutual funds? And if yes, can you suggest some? I don't know, maybe he's talking about the manufactured portfolios.
Yes, I don't know what exactly it's referring to, but you only have third-party aggregators who provide you information on all funds, because on a fund company's website, you only get that particular company's information, and you can also invest in their funds. But you have aggregators. There are two kind of aggregators. Aggregators like me, who are looking at the universe of fund, and who do not enable transactions. We do not sell mutual funds, or we do not sell investments. And there are aggregators who are selling mutual fund, and they're helping you compare things at their own website, and then helping you make those investments. So I think both of them. We work with all the leading fintech companies which are doing that. We are actually a data supplier for many of those companies, and they have done a good job in terms of when I look back 20 years back, it was impossible to think that this information on mutual fund will be democratized and will be so live every day. You can now compare the performance at midnight based on today's evening NAVs. Just to give you a context that, mutual fund NAVs, when I started value research in 1990, it was that, the rule was to declare the NAV every 3 months and publish it in the next 2 months. So the NAV as on March 31st, it was mandatory to publish it in some newspaper by the month of May, by end May. So you can understand that now on a daily basis, you have everything live available on AMFI India, the NAVs, or our places, our website, or the aggregator's website, and you exactly know how your investments have done that particular day.
So one Mr. Devendra, he wants to know about your take on value funds. So what do you think about them?
Yes, value fund has been completely out of favor, and they have stuck to their ground. They have stuck to. In fact, they haven't been distracted. They have retained their focus, and they have been great underperformer. And now it's a full market cycle where they have done very poorly. And I'm just beginning to see, and they're high quality companies. So it entirely depends when the market will actually take note of that. But I think, as I was saying earlier, that there is a cyclicality. There are things which go out of favor, and they can't remain out of favor for such compelling companies or for such large scale companies to be out of favor. And at a certain point, everything becomes attractive. Sometimes the dividend becomes very attractive, or sometimes the whole business looks so compelling that investors, there is some kind of herd mentality in the market. People don't notice till somebody actually comes and buys it, and we see a price surge. Because today I find a large number of companies which are very attractive, and investors haven't taken fancy to those, and there will be turnaround. And I think, but have patience. If you have done all the waiting, don't get out of them now. If you invested recently, maybe you can walk away. But if you have done all the waiting, I think it will be inappropriate for investors to walk out of your value funds today. Another important thing I would like to say, that most of us, most investors have their investment in growth funds, and most mutual funds or equity funds are growth-oriented equity funds. Value funds are far and few. And make sure that value funds are not a very significant part of your total portfolio. It could be one of the 4 funds, but it can't be 100% of all your money. So having a balance there is crucial.
Mr. Karthik has a bit of a regulatory question. He's saying that there's so much of expense being charged by mutual funds. Can SEBI kind of link this expense ratio with the performance, scheme performance? You know? Is that possible so that the expense goes down?
Yes, Lokeshwari, I'm part of a small committee of SEBI, where this has been talked about. And last year, this committee actually evaluated. This was being discussed in great detail. It is not practical. It is not possible to link it because all are open-end funds. How do you actually charge or vary the expenses on a day-to-day basis when investors are coming in and getting out? But at the same time, the mutual fund expenses were reduced substantially. The formula which was followed for all these years since the enactment of the mutual fund regulations, was changed and reduced substantially. And I think market forces will actually drive it. We see it in the fixed income market itself, where mutual fund companies are allowed to charge more money, but all of them actually charge far less than they are allowed to. I think over a period of time, there could be some impact on the equity funds. If you have some ideas, please suggest. But because of the open-end fund, it was not practical. There is a thinking that how to link the performance to the compensation, but there isn't a practical way of doing it or implementing it on a day-to-day basis.
One anonymous person is asking, when is the right time to book profit in mutual funds? We did touch upon it. Yeah.
Book losses.
Yeah, I talk about book profits.
Book profits. Okay.
Profits. If you are sitting on 10%, 20%.
Okay. When to sell your investments is what.
Yeah.
Okay.
Yeah.
I think the first reason when you should be selling your investment is if you have achieved a goal. You thought that if you are saving or investing for your car, and you thought that you will buy it in 4 years' time, and you have been lucky with the market. By all means, take that money out and go and buy the car. Have an advance enjoyment. That's one, when you need the money. And second is the reasons for which you bought the fund. You like the fund, and those reasons have disappeared. You like the fund because it was consistent. You like the fund because it was managed by a person. And then you like the fund because it has good ratings. So, if all these things change or some of these things change, worry about it. And if they look like, if you have fewer investment, you'll be interested. So if something changes and you think that they're of permanent nature, sell that investment.
Yeah, there's one question from my side because we used to talk about long-term in, how do you define long-term in mutual fund investment? Because it used to be 2 to 3 years, then we stretch it to 5 years. Now it's become almost 7. So what do you think? What is a long-term for a mutual fund investor?
Yeah. I would say that, long-term is a very relative thing. For a day trader, a week's investment could be long-term. Our tax authorities actually say that it is 1 year is long-term. Or for fixed income, 3 years or 2 years is long-term. So there could be different things. Or when you buy a house, 3 years is long-term. So it could be different things from different points. But I would say that for equity investors in a mutual fund or investors in shares, for them, the long term should be about 5 years. Simply because, I have seen that if you look at the market, ever since we have the Sensex history available from 1978, we are able to get a full market cycle at least in a 5 years time frame. We are able to capture at least a down cycle and an up cycle. And any period lower than that, because if you miss out on the up cycle, it's disappointing. And if you are able to catch a down cycle and you have done the waiting and if you are lost patience. So I think, 5 years time frame, any 5 year time frame, we find that you are able to get a reasonable part of a full market cycle.
Okay. Just take one last question because it's time almost. Mr. Rohan Ganorkar, he wants to know your take on the international mutual fund.
I like them simply because I like mutual fund. It's an instant way of diversifying. We have our jobs here, we have our assets here, and we have all our investments here. So why not invest abroad? That's one. The other is that it's also just as convenient as investing in a domestic mutual fund. You can do that. And then some of the companies in which you are able to invest through some of these international funds. We don't have such companies in India. We have our own good set of good companies, and we have our own set of bad companies. But we have some distinct kind of companies. For example, the new technology or what you are able to gain access through a NASDAQ 100 fund is unusual. They are dramatically different companies, great growth, global growth stories, globally diversified businesses. So they turn out to be great investments, and they are not capital guzzling business. So that's the reason. So you look at international fund is one way of looking at it. You diversify. The other is the investment case. How strong is the investment case for investing in those funds? That is also just as important.
Okay. Thank you so much. I think we've covered a lot of ground about investing in mutual fund, and I hope
for this opportunity.
Yeah, I hope viewers got a lot of insights from this discussion. I just want to put across that the views presented here are Dr. Kumar's, external speakers. Yeah, so thank you so much everyone for logging in, and thank you, Mr. Virendra Kumar, for so patiently answering all our questions. Thank
It
you
has
so
been
much.
my pleasure. Thank you.
Yeah.